welcome to this episode of CFO 4.0. As usual, I am your host, Hannah Munro, and we've got a bit of a difference in topic today. So with me today, I have an expert in all things M&A and investment strategies. So we're going to talk through some really interesting topics around how we should be thinking right now. So with me is Bill Fink, who is the head of US Middle Market Banking at TD Bank, which is America's most convenient bank, as Bill assures me. So welcome, Bill. Fabulous to have you on the show.
Hannah, thank you for the opportunity. It's a pleasure to be here and speak with you.
So Bill, before we jump into the topic that we're going to be talking about today, tell us a little bit about yourself. What was your journey to TD Bank?
Well, I'm a career banker, and along the way, I have been an accountant where I have done business advisory work for middle market companies, both private and public. And as a result of my career banking experience, some years ago, TD Bank and one of its predecessors was looking to grow its middle market business. And that led me here to the bank, first as a senior U.S. credit officer. I headed credit management, and that's credit production, underwriting for all segments of the bank, including middle market. And then several years ago, our then president asked me to take on the sole responsibility to take our middle market group. And in the process of that, we're taking our middle market business, which we define as business for companies with revenue of 100 million to $1 billion plus, national. So we are very active in the market. We have a growing business, and it's really been those steps that led me to TD Bank and to really focus on middle market.
So what are some of the trends and patterns we're seeing in that middle market, but in the world more generally at the moment, that are impacting your customers and how they're investing at the moment? Well,
Hannah, there are several, but they're really broad themes that continue to impact, I would say, all business, and middle market is a big part of that business. And so, number one, it's been hard to ignore since March of last year. The Federal Reserve, in response to spikes in inflation, began driving up interest rates. And as we hold this podcast today, they've undertaken 10 increases, moving from basically a zero interest rate to 5.25% for the Fed funds rate. So that has had an enormous ripple effect across all segments of business, including the middle market. So quite simply, the cost of capital has gone up. The cost of debt has gone up. It's put an overhang on capital. It's had an enormous impact on the structure of deals. It has impacted earnings for companies, both gross margin and as it trickles down, EBITDA margin. As a result of those uncertainties, valuations in the marketplace have come down and have been, in some industries, still depressed. Some are beginning to recover. And all of this confusion, in addition to geopolitical impacts, has really caused the middle market and M&A activity on a broader basis, not just in middle market, to be very much restrained. So you see that first quarter of 2023, and as we speak today, through the early second quarter, the end of May, the number of M&A deals is down on a comparable basis about 30% year over year through what is now just about the end of the second quarter. The expectation is until we get some signaling of interest rates, and it appears based on Jerome Powell's testimony, at the House Financial Services Committee, that the rates will be going up another 50 basis points and 2 more incremental, that the outlook for the balance of 2023, I would say would be restrained. And it'll go into 2024, probably the early part of 2024, M&A activity will be restrained. The leveraged buyout market has also been impacted the same way, and activity has been restrained. But when I use the word restrained, it doesn't mean that there's no activity. So for CFOs who are strategically thinking and have balance sheets that are liquid and low levered, this is an opportunity. And I stress that I had been with the bank. I had watched the Great Recession in 2007 and 8. And what I saw there is companies that were well positioned for strategic thinking and looking forward were in many cases able to undertake some strategic initiatives, either an acquisition or equally potentially a divestiture for a business that didn't strategically fit any longer, or the outlook for that business didn't have as strong a growth trajectory as other businesses in their portfolio did. They divested those, they freed up capital, and then they were able to take advantage while in many cases competitors were restrained or on the sidelines and leapfrogged coming out of the Great Recession. So I'm anticipating, and as I go to market in my role here at TD Bank, and I talk to CFOs of many companies, there is a growing pent-up, I'll say, anticipation that as the Fed begins to signal reducing rates, and in 2024 into 2025, rates begin to come down, that M&A activity will again rebound, leverage buyout activity will again to rebound. But my view is there are select instances where acquisitions may be available and you don't have to wait. And we can talk specifically about some of those criteria to drive that. But I hope that gives you a perspective on a broad basis of what's happening in the market.
And it's really interesting because over here in the UK, obviously, we've got updates around the rates changing as well, because I think we're under a greater inflationary pressure in the UK than you seem to be in the US. But how is it impacting in the US at the moment?
Well, there's no question inflation is still real. It has abated as of last week. Our latest consumer price index numbers came out, and while inflation came down to 4.4% through the month of May, the core inflation still remained relatively high at 5.3. Now, clearly a reduction to where it was 12 months ago, but by the Fed standards, it's still too high, and a lot of that has got to work its way through the system. And as is often said, monetary policy is a blunt instrument. It takes time. There's a lag effect, but there clearly is an abatement of inflation, but not enough for the Fed to take its foot off of the accelerator to increase rates. So we'll see that as we look forward. History as a guide through recessions and recessionary periods since World War II, and we're not in a recession yet, but when you go back and you look since 1948, once the Fed stops raising rates through history, it suggests that 6 to 12 months after the Fed stops raising rates, that rates will begin to come down. So the expectation is that there will be rate increases through the balance of 2023, whether that's July, September, or it goes into October. So in 2024, there should be the first indications that rates are going to come down. And that will be good for M&A activity, leverage buyout activity, as that's, I'll say, uncertainty diminishes. But again, I stress that people don't have to wait to undertake those now. The deals that are out in the marketplace are smaller. They're more strategic. We term that bolt-on acquisitions and carve-outs, that they're not the headline-popping deals that we would have seen a year ago, 2 years ago, 3 years ago, in most cases. But they're more strategic. And as a result of that, that's reflective of the times that we're in. Deal structures, because of where the cost of debt is, and banks have become more conservative as a result of the turmoil that took place in March. So the typical deal structures where historically the equity component in a deal would be 35 to maybe 45%. And that's a broad indication crossing over lots of industries. today, because the cost of debt has gone up, there's economic uncertainty, banks are more conservative. You're seeing in many cases that the equity component is 50% and interest rates are higher. And the reason for the 50% is really two fundamental things. Is yes, banks are more conservative, but the cost of debt is more. As a result, debt service is more with higher cost of debt. So that the earnings that are available to service debt, usually measured by EBITDA through a fixed charge coverage ratio, that stress on fixed charge coverage has gone up as rates have gone up, and earnings can't keep pace as fast as rates have gone up in the last, certainly the last year at 525 basis points. So as a result of all that, the equity component has come into play to be much greater. When you look at greater equity into a deal, the returns on capital that are invested come down. You like to ideally have more leverage, less equity to be able to drive those returns. So that's impacting the marketplace. But where you can find opportunities, bolt-on opportunities that can be done with a combination of some equity and some debt, and banks are relatively affordable on a historic basis in today's environment, even with Fed funds at 5.25. I looked just yesterday talking about an opportunity for a client. SOFR today, 30-day term SOFR is 5.08%, and 6-month SOFR is 5.3%. So it aligns very well to where Fed funds is. And while that's much higher than it was a year ago, when you go back in history and look, that's not exceedingly expensive on a historic basis, and debt is certainly less expensive than what equity is today and the demands on equity. So that combination of the two for companies, particularly if they have cash and can employ the cash, and if they need to go to the debt markets, debt is still reasonably affordable. And to the extent that they have to raise equity, the equity piece still can be brought in at a reasonable balance. But the size of the deals, and I'll be as specific as I can, you're seeing many more of the bolt-on deals. Again, not the headline catching ones that tend to get on the top of the pages of the financial press, but the average bolt-on deal over the last 6 months has come down about $200 million. For a middle market company with predictable reoccurring EBITDA, revenue stream that's balanced, and has had, I'll say, a strong and consistent gross margin, that becomes a very reasonable deal. And so on the one hand, those tuck-in bolt-on acquisitions to either go into new markets, to augment existing products or services, and in some cases go into entirely different, presents an opportunity, and it becomes a very affordable opportunity.
Yeah, because this is obviously the interest rates have gone up dramatically, but I think sometimes we forget that where interest rates have been in the past versus where they are now, because we're so used to working in such a low interest environment, aren't we? Like I do remember interest rates being a lot higher, and it wasn't that long ago either.
Yes, you're exactly right. I would say the period from the Great Recession to a year ago in March of 2022, when you look back historically, is, I would say, an abnormally low interest rate environment. History would suggest over past 100 years, having near zero interest rates for extended periods of time is not the historic norm.
And I think that's the challenge, isn't it? We're coming out of that, and it's about the current interests being seen relative to the recent interest rates. And so, yeah, it's interesting what you're saying about things being affordable, because the perception is that interest rates are too high, but it's not in the big scheme of things.
Yes, Hannah, exactly. When you look at, if you have the ability to make an acquisition that would deepen a market penetration, go into a new market, uh, or same thing from a capital investment standpoint, which involves debt financing. And you look at, okay, well, I have to take debt in an environment that it's 5+% interest rates, understanding where Fed funds is today. You'd say, well, that's more expensive than it was 2 years ago, 3 years ago, et cetera. And there's no question that's the case. But it can make very good sense in this context that if you're making that investment and the return on that investment really is strong, and finance would say, classic finance would say, well, you would measure that on a net present value basis, discount it, and anything that would be positive, you would make that investment. I would say that what CFOs, as we work with them, the world's a little bit more complicated than that, and it demands a little bit more sophistication. You look at it on a risk-adjusted return on capital. So most CFOs are challenged to provide returns on capital, certainly 15% or greater. If they're going to the market and if they're issuing equity to get that capital, they're issuing debt to get that capital, 15% on an equity basis wouldn't be enough. On a debt basis, something north of 15% would be pretty much the norm. So if you're able to go in on a risk-adjusted basis, incur the debt to bring a positive return, it makes great sense, even in this environment. The other part of it is you look at it through history, again, a 5%, 5.25% Fed funds rate is not absurd. But you can take the view, understanding where we are today, and do a little bit of, I'll say, financial structural engineering, and take advantage of, if rates are coming down in 2024 and 2025, you have the option of, you can certainly make an investment today, make a merger, make a capital, or undertake a merger, or make a capital investment to drive that return. And then look at, if you have this in mind, take short-term debt instruments with the idea that as rates come down into 2024, 2025, maybe 2026, you'd say, I'm going to refinance that debt. We're going to take advantage of, undertake the acquisition or the investment today, have a productive result, which justifies undertaking the expenditure, and then going to the market and say, well, if rates come down, as it's been discussed, that the Fed may look at, as they begin, 3 rate reductions. Well, that may be 75 to 150 basis points. No one knows with certainty, but if it were to come down to that magnitude or more, you could come back and refinance that debt at a certain point in time. So the benefit, quite clearly, is you have the economic returns that are being driven by the acquisition or the capital investment, and then you manage your debt service over time as rates come down. So we're having lots of conversations today about how that fits. And I wish I could tell you there was one simple answer, but I look at it, this is where the value of your banker comes into play, and that they become your partner. And we believe in that greatly here at TD Bank, as being a leading middle market bank, that we have those conversations with our CFOs, with the presidents of companies, trying to position this to determine what's right for them.
And that's very much focused on things that CFOs that are looking to acquire could potentially do to structure the deals and, and take advantage of the current market. What about those that feel like they need that or they want that acquisition? Is there something that those that are going into a deal need to think about so that they are attractive to an acquirer?
Well, if I look at showcasing, number one, what's the consistency of revenue? Mm-hmm. Number two, what's the consistency of earnings? An attractive target can begin there, but it doesn't end necessarily there. But I would say those would be the hallmarks to start with. Then you get into other things that become important and become very industry specific, product specific, etc. So I'll move off of the financial considerations. I'll say directly, in this day and age, and you look at today, in the U.S., the JOLTS index, which is the job openings index, as of the end of April 30th, there are 10.1 million jobs that are open. I would say access and retainment to skilled workforce is becoming a bigger and bigger issue. And so when you look at one of the criteria that make a company attractive is, do you have a specialized workforce? Do you have, something ingrained in your workforce that would be complementary to another company? It could be specialized technology, it could be specialized engineering. All people working in those areas could become highly attractive to another company. And so being able to acquire that company for that. The others we talked about are new markets, whether they be domestic markets, foreign markets, that would make a company more attractive. The other possibility is that you have embedded, because of maybe the growth of a business, you have a division that has a very promising future, whether it be technology, whether it be product, but you haven't been able to readily invest in that. Now, you can carve that out and try to divest that, but in a private company, that becomes very difficult and almost impractical to carve out. Public companies have better chances of doing that, but you can be attractive to acquire an element of your company, a division, a line of business, and begin to position that with competitors. And people in your industry who know your business as a competitor are very likely to understand those advantages. So then finding the right partner, and that TD, through our colleagues at TD Securities and TD Cowen, buy-side, sell-side M&A activity is something that they do very readily. So finding the right partner to begin to position you, if you're looking to go into the marketplace, to be on the sell side of the business or to carve out a division, you need a very skilled partner. And we have the ability within our organization to help people, I'll say, navigate that road, which isn't a clear path always.
Absolutely. I think certainly when things get complicated, bringing in the experts is always the first piece. And we've talked very much about the US market. What about internationalization? So are you seeing much activity with international markets, international entities, or are you seeing a trend to really focus in on the US?
I would say the dominance of what we see is in the US, but where we do see opportunities, companies continue to look to diversify sources of supply, sources of manufacturing, and markets. It's largely, I would say, Europe or the Pacific Rim. And that's just based on the experience that we have here. It's not that the other markets don't offer opportunities. I want to be very clear about that. It's just where we see our client base focusing is in Europe, and it happens to be the Pacific Rim countries.
Yeah. And it's interesting, that pattern. And do you see there's more or less opportunity internationally at the moment with obviously some of the changing environment globally? Do you feel like people are shifting more to look inwards in the US, or do you feel like there's actually more, like you say, a diversification strategies coming in around both supply and sale?
There's a lot of elements to your question, so let me try to break them down. I would say we're in the early innings, if I could use that analogy, of as a result of the COVID pandemic and the impact upon supply chains. And I would say clearly, as we talk with CFOs, and our customer base is U.S. domiciled, there is a focus about repositioning supply chain diversification. It's too early to say, does that bring everything back to the U.S.? My expectation is it does not. I look at there will be greater sources of international supply, and it won't all come back to the U.S. But I expect there will be some opportunity for things to be returned to the U.S. It will not be exclusive, but there'll be, even on an international basis, much greater focus on having diversification among suppliers, looking at the links of supply chain, vulnerabilities in supply chain that really became clear as a result of the COVID pandemic.
And we've obviously talked about there's a huge amount of opportunities. Is there any other opportunities that you're seeing at the moment in the market with the shifting conditions?
Well, one of the things that we do see, and we've talked kind of on a broad basis about M&A and leverage buyout. So one of the things as CFOs contemplate where they are, particularly public companies and private companies, is the emergence of private equity. And private equity is, here to stay. It's been here, and it's really manifested itself. And we work very closely with a large number of private equity firms to provide financing for their acquisitions. So as companies look at where they are today and the industries that they're in, and there are in the middle market at any given point in time, there are 1,200 to 1,500 middle market private equity firms, and they are generally very specialized. They focus on industries. Within industries, they focus on segments. So if a company looks at its marketplace, it very easily could be approached by a private equity firm, and that I would say shouldn't be ignored in that regard, because private equity firms can help businesses grow larger. They can provide expertise by having segment focuses that maybe existing management teams don't have the depth, don't have, I'll say, the experience in certain aspects of growth on an international basis to bring other partners to the table. And private equity firms can use a business either as a platform, or they can have as addition to a platform to be able to grow. So that's one. And then, Hannah, the other one, what we see that has been around for a long time and hasn't really come as clearly into favor, with private businesses, we have seen here at TD in the last 2 years more opportunities to do ESOP financing, so employee stock ownership programs. And we have done a number of transactions, and it's something that I know quite well, ESOP financing. I've done through my career 14 ESOP transactions, large ones, small ones, over the period of time. So we have a business owner who wants to maintain control, wants to pass on the business to the employee base, and they arrange an ESOP. And as I speak with you today, we're in the midst of two very nice ESOP transactions, for manufacturing company and professional services company. So that's the other leg to the stool, if I could phrase it that way, that's sometimes overlooked. That people say, well, what do I do? What's that succession plan? And that the succession issue, given where we are, the baby boomer generation is advancing through their professional working lives. And there's, over the next 10 years, there will be a huge opportunity for them to liquefy their business interest. It's one of the largest maybe in history. And that, some cases, can mean sales to private equity firms, sales outright to other firms in non-private equity transactions. But it also, the one that sometimes is missed, and we're well versed again, is providing ESOP financing to make that continuity of ownership continue with employees, but also provide a vehicle for private business owners to liquefy some of their business interests.
Yeah, and it's not an option that's talked about a lot, isn't it? So it's great to hear you to bring that up, because it's something that you don't hear mentioned that often. So it's an interesting concept.
Yeah, it's people sometimes get, I'll say, scared away because they hear that name and they say, well, I know what an ESOP is, and then you get into it, and ESOP is it's an ERISA program. So people get sometimes nervous when they hear ERISA in the U.S. So it's like, it's going to be bureaucratic, it's going to be complicated. It's like anything else. You find the right advisor, you find people who are familiar with the financing, how it's done, and it can be a wonderful opportunity to make a transition for a business owner and reward loyal, longstanding employees. So I would say it has its time and its place. It's not universal to everyone, but to your point, it's one that's often forgotten. But as we sit and we talk with business owners, and in this context with ESOPs, it's private business owners, about what are the options. And we just recently had this opportunity. We have a client who's been approached by a private equity firm to buy a controlling interest. And as he's gone through the options, very favorable proposal. And you really have to start, money's important up to a point, but let's back up for a moment and really talk about what's important to you. What do you want to do? What is the number one priority that you have? Is it to stop the day-to-day? Is it to liquefy the business immediately? Because that has a certain answer to it. And that could be the private equity, could be very appropriate. And you look at it and you say, well, I'm concerned about my employees. I'm concerned about the direction that we have. If I give up a controlling interest, do I still have the voice that I want? And you talk through all of those concerns. And I look at it almost like, let's get them all down on paper and then work through the process to really weight them. Because it doesn't matter what my perspective is on it, it's what the business owner's perspective and what do they hold near and dear and how they mentally weight those factors. And we've worked to do that. And as I said, it's not universal, and it's not the, open answer to every question, but it does have its time and its place. And where it does, people can be very happy knowing that they still were able to liquefy their business at a very favorable rate and walk away and take some money off the table. And the nice thing about ESOPs is to get their tax advantaged. In order to be tax advantaged, the initial sale to an ESOP trust it needs to be 30%. So they can do it in increments. And for some people, that is the perfect answer, is that I don't want to walk away from the business, be out of the business if this has been my life's work, and a gradual transition at a 30% increment. And then whether it be a second smaller increment or the second increment is the remainder of the entire business shares, that's something you can work through. So a good bit of flexibility there, and it could provide a different opportunity.
Yeah, and it sounds like actually what we've been talking about on this entire podcast is actually the opportunities that are available given everything that's happening. So just to sum up for our listeners, so perhaps given the highlights, so what do you think are the biggest opportunities given the current financial market?
Well, I would say as you get beyond the headline, and there is lots of headline noise, and you need to be cautious. There is no question you need to be cautious in this environment. There is tremendous uncertainty domestically, internationally. There's not a clear picture on the markets. But the message I would leave with people is there is opportunity. Right now, it's more bolt-on acquisitions and carve-outs than, I'll say grand slam opportunities. to buy and do something on a headline basis, but it remains there. Financing is one consideration, but if the fundamental opportunity, whether it be an acquisition, a capital investment, makes sense, drives the business forward, brings a positive return, then it makes sense to look at that in this environment to position the business for the future now. And in the context of the larger environment, the financing environment, whether that be the bond market, the IPO market is relatively weak because of uncertainty. The bond market has begun to come back a little bit. The high yield bond market has begun to come back. And there's been confusion since March in the commercial banking environment. But I will say to you, from where I sit at TD, we are open for business. We are looking for business. The opportunity continues to exist for us to help customers, and we're well positioned to do that for the future.
Absolutely. Well, thank you so much, Bill. It's been really interesting to understand the market perception, from almost the other side of the fence, and understand what you're seeing both with customers and obviously as a bank yourselves. So thank you for sharing your knowledge. If people want to learn more about TD Bank and perhaps yourself and what you guys do, where's the best place to find you? How can they learn more?
Well, they can, if they would like to contact me, my email is william.fink@td.com, or they can go to our TD website, which is td.com, and contact us that way. But we are open for business. We are among the most well-capitalized banks in the U.S. and continue to look to grow for the future.
Exciting times, hey? Well, thank you so much to our listeners. And as always, your feedback is welcome. So if you've enjoyed this episode and you'd actually like to dig in more to the world of M&A, financing, and take this podcast on a more technical route, then absolutely, please do reach out and let me know. I'm always looking for ideas and inspirations, even if it is outside my area of expertise. I want to say thank you, Bill, for joining me on the show today. And to our listeners, as always, the door is open. Reach out on LinkedIn, and we will include all of the links that Bill mentioned in the podcast notes. So thank you, Bill. Thank you to our listeners for joining me on this podcast, and we'll see you soon.
Hannah, thank you. It was a great pleasure.